I love fraud. Oh, don't take me out of context.
You ready?
Yeah, sure, let's do it.
Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Thomas Braziel of 507 Capital Management. Thomas has got a specialization in some very unusual securities. He likes things in bankruptcy. He likes fraud. He likes something that's well off the run. We're going to talk to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hi, Tom. How are you?
Good, how are you?
So we've been having some great conversation before we started, and I hope that we can keep that going. Now, you're very...
I'll try.
The way that a mutual friend of ours, Toby Shirt, introduced us, and he said, you've got to read this story. And I remember Toby telling me about this in real time as it was happening. Ethnix Energy. Can you take us through...
Oh, really? That one? Yeah.
What happened? Or maybe it was fun.com. I think maybe it was
fun.com. Very similar.
Let's start with Ethnix Energy.
Yeah, so it's great to be on the program. It's fun. I'm glad you're doing the podcast. It's very cool. So I've been binge watching a few, and it's great to chat in person or chat, to really chat. So I've always been interested in investing. I don't know where to start with Ethnix. I guess How
did you find it?
Yeah, so actually, believe it or not, Ethnix was on a net screen. And I was in grad school at the time, and I was studying, believe it or not, quantitative finance, which has nothing to do, although I wouldn't say nothing to do, but because it's all kind of about investing in business. But so I was supposed to be studying my quantitative finance. Instead, somehow I ended up picking up the newest edition of securities analysis with the forwards by all the sort of current managers, which is phenomenal. And I had actually read securities analysis when I was like 19 or 18, but the long story short was I read like edition 4 with like all the coddle, like they kind of ruined it because they gutted a lot of the Graham philosophy in the middle. So you really want to read the first 2 editions, or you want to skip forward to the new edition, which is
100%.
Okay, yeah, okay. So you have to be a real nerd to like sort of be like, oh, the editions are different. You need to. So anyway, they really are. I swear. So the newest edition, and so I read it and I was like, just sort of blown away. And one of the things that there are so many great Graham stories in there. One is in sort of investing in liquidations and investing in litigations and like all these crazy things. You think like, wow, that's Graham. Everyone thinks you think Graham, you just think net. You don't really think of all this color that he had on really doing special sit and situation investing. And so I read the book and I was like, oh, my parents are actually bankruptcy lawyers, not like big time bankruptcy lawyers, but they're bankruptcy lawyers. And I was like, I know a decent amount about bankruptcy. Like I'll start looking around at, for stuff as it comes up. And I happened to come across, I was, trolling on a net screen. And one of the companies on there was a company that was bankrupt. And it was like a tiny market cap. I mean, really small, like $200,000, $150,000 market cap. So absolutely tiny. This is not for any managers. This is all for home gamers, I guess is the term. So any home gamer out here, and there's stuff exists that you can, and that's one of the things I hope to get across in the arc of this conversation, which is I believe opportunity is everywhere, and this is a great vignette of that, I think. So I found this company and I noticed it was in bankruptcy. I said, I know about bankruptcy. Why don't I try to research it and see if there's something here? So that's how it all started. That was the premise. So I started pulling open the bankruptcy docket. I don't know that much about, at the time, I didn't know much as much as I do now about distress and bankruptcy and how things work. And it was a Chapter 7 liquidation. It was actually a no asset case, which means that the recovery to the equity would be almost like just a very long shot. But when I was reading the trustee reports, I was saying, oh, look at this. This is quite interesting. Like the recovery to the equity could be like just a tiny amount. And in fact, actually, because of the way the company was taken public, they actually have a pretty good lawsuit against the former director, who was also their legal counsel, and that helped them do. Basically, the company had gone public through a reverse merger pipe deal, and the guy that had helped them with reverse merger pipe was a partner at McGuire Woods, which is like a large law firm. You can Google him, and he basically lined his own pockets by taking part in the reverse merger pipe deals with his own capital, and then basically flipping the shares after the first day. And he sent out bogus opinion letters with the McGuire Woods stationery, being like, yeah, you could take the Legends off these guys' shares. They're good. Well, what he meant was good, but he meant his own vehicles were good. So that was the fraud. It actually worked really well. So he did about 7 times. He never spent the money. I mean, he didn't spend maybe a little bit of it, but the real recovery was the fact that he didn't spend any of the money, and then when they sued him, he had all the money. So that was a forfeiture action with the government. So in that case, there were two sources of recovery. One was, and this was all in the bankruptcy docket if you were able to crack it open, was that you could get some recovery to the equity actually through these what are called restitution and remission payments on forfeiture actions. So if the government seizes your nice telescope behind you because you're a drug dealer and they've taken all your stuff away, and let's say that somehow you had a claim on that property because you defrauded me, I could actually get that telescope. And that's basically what you do. You in these forfeiture cases, this guy had defrauded the company, so they had a claim against him, and so they were able to actually, through the short swing profit rules and actually restitution payments for charging him for his legal services when really he was defrauding the company, they were able to demand money from the government seizure. That was one
he was
source of
charging for his fraudulent services.
Yeah, that's great. You get it coming and going. That's a real business there. I'm in the wrong business.
That's smart.
Yeah, exactly. So this guy, so that was one source of recovery, and that was like plain in the doc. Like you could have read what are called the trustee reports, and Chapter 7s are different than 11. So Chapter 7s are like where there's you're Australian. In Australia, they call them administrations. In the States, we call them Chapter 7 liquidations. And basically, there's a trustee who comes in. He sits in the shoes of the manager and basically just liquidates out all the assets and tries to pay the creditors depending upon the pecking order, right? So you've had like secured creditors, preferential creditors, like wages and things like that, taxes, and then at the very, 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 very bottom, the equity holders. In this case, because of the restitution and remission payments, I knew from my purchase price, which is about a $200,000 market cap, and we were talking about the penny stock basically, that I was going to make 4, 5, 6 times my money, which I was like, whoa, are these numbers right? So of course I'm like calling the trustee and I'm like, getting him to walk me through line by line. Is this accurate? Is this right? What's this now? What's it? And the trustee didn't even understand what's funny. And this is what I find interesting about opportunity in general is someone can be so close to the opportunity, but they don't have like the mindset because they're too busy like keeping whatever cap they've got on. Like this guy, he's like, I'm just a trustee, like I don't know anything about buying bankruptcy claims or buying equity. I mean, he very well knew the story. He could have told his friend the story, and it wouldn't have been insider trading. He said, hey, you should really look at this bankruptcy case. This is a little public company and there's stock that trades, but he never did that. So this trustee, who's now a good friend of mine, he didn't add it all up. So anyway, so that was one source of recovery. And then the other big source of recovery was a lawsuit against McGuire Woods because partnerships are liable for the actions of their partners. So you can't throw somebody under the bus if they're literally a partner. And I don't mean partner like Goldman Partners. There's no Goldman Partners anymore. It's a public company. But I mean like real partnerships. If Goldman was private and those guys that claim that their managing directors were actually partners, then they would be liable for their actions. It's actually a good risk mitigation tool for Goldman, so it's probably good they went public. So those are the two sources of recovery. If I was older and knew a lot more about distress like I do now, we could have really done well. But we still did very well. So I basically bought up about 10% of the stock in the public market, which wasn't a lot. I was broke. I was a college student. I wasn't broke, but I was like bound to have, I had $10,000 basically to buy the stock. And then I also
Did you file your 13D?
I did.
Did you really?
I follow the rules. I follow my 13D. I follow my 13D and 13DAs, man. I mean, I'm like, I'm on it. And I did it myself. I didn't pay $400 for somebody else to do it. You should see it. The formatting is terrible.
Handwritten.
Yeah, handwritten. Actually, I bet you could do a handwritten one. I don't know how you'd file it though, because it's all the Edgar filing system is all electronic now. But maybe you could. I don't know. But yeah, totally terrible formatted. Terribly formatted. But it's not that hard. You can, But so I bought a public stock. I bought about 10% at about $200,000 valuation, and I also bought some restricted share blocks. So I actually have physical certificates that I bought off people. Which was a lot of fun. So that kind of reminds me of the old Buffett story. And I can't remember what stock it was that he did this with, but I really felt, at the time I was actually reading Snowball as well. And I remember of him going door to door apparently to buy some security. And it kind of reminded me of that story. So I felt good about it. I was like, oh, I'm just like Buffett. I feel so good. Except for in the Snowball, she says that he was breaking Williams Act rules. So I started searching Williams Act, and I was kind of worried that I might be breaking Williams Act rules. But she's actually wrong. There's no anti-solicitation for stock that's legend stock, because it's legend stock. It's restricted stock already. So it would only be anti-solicitation Williams Act rules if it's like, publicly traded stock. So if I said, hey, Toby, why don't you sell me I'm going to guess what stock you own. Let's see, Merlin. Let me buy your Merlin. Oh, Merlin just got bought, so I think of something else. Let's think about a value stock. So anyway, that was a fun case, and I could give more color on it, but that's the gist of it. And
so you bought the shares. Some of the restricted stock that you bought was from, including the chairman, right, of the now.
I did. So the largest. I wonder if I can do a screen share of this. I can show you the certificate. So recently, I've been wanting to do this forever, and I finally did it, which I had like a little tombstone made of the actual share certificate, which I love. And I haven't actually seen it because it's in New York, but I just love the idea.
If you send me the picture, we'll put it up on the post.
All right. I'll send a photo. So it's the nicest guy ever. And I'll give you some of the story on this. So this guy, remember who this was? This was a ethanol company that was going public during the heady times of sort of alternative energy pre-financial crisis. So they were doing a reverse merger pipe deal. Pipes were big, you get basically like, so anyway, so the reverse merger pipe, and this guy was like the industry guy for ethanol. So they made him the chairman, and they gave him a bunch of stock and all this stuff. So he owned like 10% of the company, basically just to come in and add gravitas to the project. And so when this thing went sideways and this guy ended up defrauding the company, there was a big sort of, this was a besmirch or whatever you'd say. This was a stain on this guy's reputation as someone in the industry. So he was more than happy to wash his hands of it. And it was so funny. I remember calling him. His name was Robert C. Walter. So I call Robert up, picks up. He's kind of an older guy. And he says, you want this certificate? He's like, this certificate's worthless. And I was like, well, I think it's worth a little something, and I think the workout value could be, over time, a few multiples of the money. I was pretty straight with him. I mean, I didn't really go into litigation, but I said, you could make some money on it. And he said, look, you send me a contract. I'll see. I wrote my own contract. This is not good advice, by the way. You shouldn't write your own contracts. I know that in hindsight. I sent him a contract. He signed it. I sent him a certified check from Vanguard. Check literally from my Vanguard,
from
index
your brokerage
fund.
account.
Yeah, my brokerage account. Yeah, literally, that's what I did. I still have the check stubs. I'm sure I can pull those up. And the guy thought I was nuts. And I think my parents are bankruptcy lawyers. My mother, I remember speaking to her. She's like, "Are you sure you know what you're doing?" And I was like, "But look at the numbers and look at the workout value, and it all kind of adds up. I mean, you just have to follow the numbers." And so she was a bit incredulous, but she was like, "All right, this is my son's money. Do what he wants. When he loses 20 grand, whatever." So I bought about $10,000 of stock. Might have been a little more than that, and then I bought like 25,000 ish of restricted stock. Mostly it was Robert C. Walter, so that was a good one to snag, and I got that under a $200,000 valuation. So at the end of the day, the workout value was about $6.5 million of from like market cap workout. It could have been even higher. But the long story short is I bought them for 4 cents, 5 cents, 6 cents, and the workout value was 92, 93 cents on the dollar.
Wow.
Yeah, it was a good one. But it was one of those things where, well, first of all, it did take 2.5 years, so it's not like it happened overnight. And what's fun about it, and I was telling you this off camera, but before we started, and you're like, oh no, wait, even though it took 2.5 years, which you think, oh my God, you made 23 times your money in 2.5 years, that's amazing. It's like I still had to wait 2.5 years because once I had bought. The fun thing about making a really good investment is I feel like you really do know pretty early on. You're like, oh, yep, that was good. Especially when it's like private deals versus public. I mean, stock, you're buying from marginal sellers, so you're taking advantage of that dislocation of that marginal buyer and seller, or supply and demand, whatever you want to call it. So, but in the private markets, normally when you ink a deal, like you kind of know, like right then, like, wow, that was good. So you kind of know, right, when you do it. You still have to wait because it's private. It doesn't matter how great you think you are. You have to wait till you actually get your cash out.
So even though you'd done quantitative finance mathematics at Columbia, and that's your master's, you got this passion for these unusual bankruptcy, liquid claims, distressed debt, distressed assets, and so now you've set up a firm, 507 Capital Management. Yeah. What's the name? What's the 507 mean?
Okay, so 507, and I should say the whole idea, genesis of BE Capital, which was my former firm with another partner, and now 507, was to basically try to not institutionalize, but try to make a business out of finding stuff like that. Finding FNXs. More portfolio approach, but basically the idea is like stuff that just no one's bothered to look at. And, try to be lean so you can be small and take advantage of it. So, 507 is actually the portion of the bankruptcy code that sets out the priority scheme. So I don't know if I told you this via email, but yeah, basically it's the people that get paid first. So it's a little play on that. So whenever you call a bankruptcy attorney and you're like, oh, are you guys looking for we do a lot of DIP work, so debtor in possession loans and stuff. And they're like, oh, they're like 507, what, like the priority code? You're like, yes. And they're like, oh, I get it. That's funny. So it's like a very inside joke on only a bankruptcy attorney. Some believe it or not, some of the bankruptcy attorneys don't even know.
It's not as that no particular section of the code is as important to them as that is to you. That's why they necessarily don't.
They should, because it lays out that they get paid like third. There's all of bankruptcy outside secured claims are the price. So the 507 is. The first people are child support, and after child support, most corporate bankruptcies don't have child support doing there, but that's the priority scheme. 507A1A is child support, 507A2A is like domestic support obligations. So basically, if you've been divorced, and then number 3 is admin claims. This is where the estate professionals get paid. So. Right. Actually, believe it or not, in one case, and actually, God, I could tell some hilarious stories. There is, was it 50 Cent or was it? Yeah, I think it was 50 Cent that filed. No, it wasn't 50 Cent. It was DMX filed for bankruptcy. So DMX has had like 9 children with like 8 different women. So he has debts. All of his debts were domestic support obligations. And we came this close to buying a domestic support obligation. You could actually technically buy them, 507A2, domestic support. That would be great. That would, because I'm trying to fill 507. I want to get one claim from every single ladder. Pick it up.
So the investment that I was referring to before, I think I got a little confused there. The one that Toby Shute was telling me about, I think he was telling me about it in real time, or maybe he was telling me slightly after the fact, but it was the fund.com investment.
Yeah. So that was like a little different in the sense that like it wasn't as sure thing as FNX. And I should say that like whenever I'm telling one of these stories, it's not like it's the only thing going on. So people, I mean, at the time, FNX really was all my money. Because I really thought that you were sort of guaranteed to make a few times your money, and then the upside was you got the litigation for free. But in Fund.com was interesting. So Fund.com was more than a penny stock. It was like a nano penny stock. I mean, it was just like it traded for literally pennies, 2-3 cents or something. And well, I guess FNX started that way as well. But it was like $100,000 market cap. The company was basically dead. The guy that ran it was a fraudster. I mean, so that's part of the story. So Fund.com was a company that was kind of basically as a pump and dump scheme. What they did is they basically inflated a fake balance sheet, and then they used that fake balance sheet to buy real companies. Sounds a lot like other companies you might know. Anyway,
that's a legitimate strategy. That's a completely legitimate strategy.
You're like, what's wrong with that? What's wrong with that strategy? I won't cough and name any companies. So the idea was a fake balance sheet, buy real companies, and it was really smart. He actually say, "Hey, Toby, you're such a good guy. I got this company. It's got $30 million in asset value. You're such a good guy. Like I know that you're going to be in for the long haul with this and this investment. Why don't I sell you some stock at half of book value? And since you're such a good guy and you're going to help me out, like you're of course going to buy it for your clients. You're not actually going to buy it. Why don't I give you a little something? Just as a thank you. It's not a kickback. Well, who said the word kickback? I'm just saying, as a I would really appreciate that. So that was the play. He would raise money with his fake balance sheet, basically pitching to brokers like IRAs and whatnot. They get their clients in, and then you give them a little something as well. So everybody's paying everybody, and everybody's happy, of course, until the thing blows up. But the interesting thing is he made a few interesting investments. One of the things he either bought or sort of drove into the company was a domain called fund.com. That was basically the premise of the whole company, was it was going to be a marketplace for everything investment related. So think of it as, I remember seeing an old deck about it when we finally got in control of the company. He basically said that it was going to be like I can't remember if he referred to it as an Amazon, but he basically referred to it as like, everything you need to know or everything about investing is going to be on this website. So it's kind of like investing.com, but it's called fund.com. So he had a domain. He had invested in a ETF provider who I really it took some color, but I won't go in specifics. But anybody who really wants to can research it. So there was an ETF provider that they owned a chunk of, and there were a few other things. So at the time, the stock was totally bombed out. Everybody knew the guy who ran it was a crook. And they were like, well, what's the point of buying the equity? I mean, anything that comes into the business, the guy's just going to steal. And I said, all right, well, stranger things have happened. Maybe something happens. Maybe I'll buy, I'll just sit on the bid and get filled. So I sat on the bid for like 2 years and basically ended up owning like 20% of the company at like $100,000 valuation. So literally it was a $20,000 investment. Long story short is I had tried a few things, activism things like books and records stuff, and trying to kind of force under Delaware corporate law some disclosure. Didn't get anywhere. And then something really interesting happened. The gentleman that was the puppet master, this guy Jason Galanis, gets indicted. He gets indicted by the government, not in fund.com, but in something else, another fraud he's got. This guy's like, he's got frauds going on in every town. So there was this, believe it or not, Indian, American Indian, Native American bond scandal. Basically, they raised this money for this Indian tribe. And then, of course, the money was supposed to go to build a casino or something. Instead, they were like, oh, yeah, well, we'll help you with this. We're the investment manager. We help you raise the money. But they never turned the money over to the Indians. They basically just kept it and spent it. So he gets indicted for that. And the guy that I kind of found the person that was sort of running the show, sort of sole director and sole CEO for this bombed out non-reporting OTC company. And I was like, what are you going to do? This guy's indicted. He's not going to be able to, and he was mum. He did not say, that's an English term. He was not talking. And eventually I was like, you know what? There's this I'd read a bunch about Delaware code to kind of do this. And one of the things I learned about was receivership. If you have a company that's basically been left for dead, you can appoint a receiver. It's very similar to bankruptcy law. They have state receivership and assignment for the benefit of creditor type stuff. It's very similar to a state run bankruptcy almost. So anyway, I was like, hey, I should really go for receivership. This is the time. This guy's not going to respond. We're going to get it by default. So we literally went to Delaware, filed a receivership motion, and got appointed receiver. What can I say? I mean, what's great as well is the guy that was running the company. This is what really happened. He stopped getting checks from Galanis. And when he stopped getting checks, he was like, well, I don't work for free, and this guy's now in jail. Maybe I should just say, like, so he actually filed an affidavit in support of us being appointed receiver, which is crazy. I mean, he was supposed to be the one running the company. So we get involved and become the receiver, and we start sort of marshaling assets. And there were two big assets. One basically was this ownership and this disputed ownership, because it was disputed how much they owed, of this ETF provider. And it wasn't a huge ETF provider. It was like $1 billion, $2 billion AUM, which sounds like a lot, but ETF margins are thin. You might know if you've ever tried to launch. Did you ever run across this company?
I know who it is. Yeah, I know that. It's Advisor Shares. I know the company.
Yeah. I'll give color without giving, because I don't want anybody to get upset. But these are the facts. I mean, the facts were there was a dispute about how much they owned. There was a dispute about a capital call. At the end of the day, there was a settlement. We were able to settle it, and kind of like basically instead of the cash just going to Galanis, who was now behind bars, we basically had it come to our corporate bank accounts, which now I controlled. So that was one source of recovery. And another source of recovery was the domain itself, which he had, of course, taken control of through a forbearance agreement, because he claimed he had all this insider debt, which was really bogus. And first of all, my favorite part about the debt piece is it was a $2 million piece of debt, but it had I think a 3% late fee per month. So basically, like the rate was like, I don't even know, like 50% per year, like APR, which is of course usurious, and we got totally thrown out by the Delaware court. So the receivership was, the advisor shares recovery through settlement, and then the selling of the domain, and that's basically a few $1 million. I can't. There's there's basically receivership reports that are out there that say the numbers, but that's a few $1 million, $20,000 for 20% of the company, not bad, And there are all the other people, there were a number of people, and I know Toby. That's why Toby and I had talked about Fund.com over the years. Because I was just like, it was always curious, and the whole premise of the investment was there's actually a lot of value here, and maybe there's a way to, good things can happen because there's a lot of value. And so this is sort of like a rhyming theme, and I said, although it was very dark, it was no way a sure thing that you were gonna really make a killing on the company in the same way that other things are more. And that's a waiting thing. That's like any portfolio, It's like, I'm not sure if this is going to work, but if it does, like, I'm going to make 100 times my money. So, okay, I can lose 2% of my portfolio, or whatever you're comfortable with, 5%, 2%, 1%. It's like any sort of portfolio. One thing is, as I get older, but also as I just try to think more logically about investing, like, I think sometimes as investors, we're a bit too black and white, and we're not willing to be wrong. And so I think it's important to remember that sort of, I don't know. I don't know what your thoughts are.
No, I agree completely. I think that if there are positions that are potentially zeros or massive payouts, then you size it like an option that could expire worthless, but could have a very high payout. That whatever that is for you, 1% or 5% or whatever.
Right. And I also think it's a setup thing. Sometimes you see a setup, because I think that's really your goal. Even in distress, I feel like the goal is like positioning and setup, position. So much of it about positioning and finding those really awesome setups. It's so much as like prognosticating about the future. Like, oh my God, like, phosphate's going to go to 5,000, and that means the stock's going to 5,500. It's like it's prognosticating. I don't disagree with people that do it, and I think there are just a million ways to make money in public and private markets in all kind of different areas. But I definitely think that in securities markets, and in a lot of places, sometimes it's more about positioning more than influencing or being able to know the outcome with certainty.
What do you mean by positioning?
Well, so for us in distress, it's like fulcrum security type stuff. So you're trying really hard to like, okay, so let's take a case. You've got, $1 million of secured, and these are really small because we do some small cases. So let's say you got $1 million in secured and you've got 10 million, you got 5 million of unsecured, and then maybe you've got, well, I could walk it through a live case. You want to walk through a live case?
Yeah, let's do that.
Okay, that's more fun. I don't want to get in trouble with anybody. So the first ICO bankruptcy is this company called Gigawatt, and ICO, initial coin offering. So they're one of the main areas we actually work on now is crypto distress. Believe it or not, it's not a hot area, but it's a hot area for us because if you're someone that likes the space, the discounts are pretty huge. Now, of course, if crypto goes to zero and goes away, and sort of it's not the future, then you're not looking at very good returns. But there are still ways to play it and get the optionality while staying safe, which is what we really try to do. And that's something about positioning. So, in one trade that we're working on, and I can't talk too much about it, but basically what we do is when we're buying bankruptcy claims in this one docket, we're basically buying something where if crypto goes to zero, we're okay with the IRR because of the estate has other recoveries, and the bankruptcy estate has other recoveries that will allow us to make an okay return. So like I wouldn't say, I guess it's a Manish Pabrai, sort of like, heads I don't lose much, and or heads I win a lot, and tails I don't lose much. This is like actually heads I make a little, or tails I make a little, and heads I win make a lot. So that's kind of stuff you can find not only in sort of crypto distress, but in all areas of distress if you position yourself properly and really think about the risk reward of every transaction. So the one live example in the States, was basically the first ICO bankruptcy, is there's a little bit of secured debt. There's a decent amount of unsecured debt, which is basically trade claims, which is like a bread and butter business for us. Another is customer account claims, and then you've got even tokens because they had an ICO. So what are tokens? Oh, geez. So it's complicated, right? But if you have an idea about what the value of the business is, and you get healthy discounts to that, and position yourself so that maybe you own a little bit of the top tier, like maybe a little bit of the secured, to make sure if things really go south, you're going to cover, you're going to be able to be there and kind of own that. And then at the same time, you're kind of layering further down. Maybe you want to own some tokens. Maybe you want to own some GUC, some general secured claims. I think the same thing, I guess, our guys that do like structured credit stuff where they're like long the bonds, and like they're using the coupon of the bond to basically be long the equity or to lever up on the warrants or something like that. And I think one of the nice things about the stress, and we were talking before we got on, is disciplines in investing. I think that the stress is really cool because it teaches you the discipline of the whole capital stack and being really creative about how you think about it. Sometimes the thing about when you're just looking at stocks, you kind of get really kind of like, it's only one permutation with just the stock. But when you've got distress, or it makes you think of like the whole cap stack. Where do I want to be? What's the best risk reward on GE right now? Is it the bonds? Is it the equity? Is it so when you get distress, it gets even more interesting. You're California, okay? PG&E, big bankruptcy case, right? Where do you want to be in the cap stack? You want to be in the bonds? You want to be in the equity? There's trade claims you can buy. There's mechanics liens you can buy. There's all kind of. And so that to me is really fun. But anyway,
did
I'm not sure what the question was.
Did you? No, that was good. You're talking about. We started out about fund.com, but did you discover the crypto opportunity through Mt. Gox?
That was, yes. So that's something we work on. Yes.
So
Can
you tell us the Mt. Gox story?
So, oh gosh, this is going to sound mean. Okay, so I was reading in the FT how some hedge funds were trying to buy Mt. Gox. This was like 3 or 4 years ago, like Mt. Gox claims. And I was
what's Mt. Gox?
So Mt. Gox was the largest bankruptcy. No, it's a large bankruptcy. It was the largest crypto exchange before it went bankrupt. And what happened was basically 3/4 of the tokens just disappeared. Tokens, Bitcoin disappeared. So, of course, people were very upset. But at the time, crypto was only at about 450 US dollars to one Bitcoin. So when you have 25% of the coins left, but then crypto 10X on you, that's 100% repay case. And so I was actually buying when crypto was like 1,000. So I was making doubles on the claims I was buying for at the time BE, for my fund. And I read in the FT that some hedge funds were looking at this, and I was like, I know a lot of the guys that buy this stuff, like that work in sort of bankruptcy trade. I'm like, they're not super smart. I bet I could figure this out. So I started poking around, and papering the first one was really hard. I think that's something about like opportunities everywhere. As people say like, oh, I don't know how to do like bankruptcy foreclosure on a or a private mortgage. I don't know how to do it. It's like, of course you don't know how to do it. Like you have to just kind of push the boat out and learn a little bit. I'm not, don't risk your whole life savings, but so in the area we work in, or I work in, I feel like the hardest thing is papering stuff. So people will say things like, oh, how do you get comfortable with this transaction? And be like, well, we do it through spending first our whole lives trying to paper stuff and figure out how to paper it securely, but also like months and months on a deal is basically figuring out how to paper it so that you're secured, not secured in like the secured debt sense, but secured in the sense of like there's no slippage between what opportunity you want to or exposure you want and like just having a papering bumble so that somebody walks up with your money or something. So let's see. So I read an FT. I was surprised. I was like, I know people do this stuff. I should say is one thing, when I was running BE Capital, it was quite a small fund. So once I filled myself up, we were always trying to we were kind of working for larger distressed firms and hedge funds. And the I don't know if it's a scary secret, but one of the funny secrets about distress is like most of these guys find stuff through other means, right? There's all these brokers and stuff. And so we sometimes work for some very large and well-known people. And so I started sniffing around Mt. Gox, and I was like, I know people that broker this stuff. They don't know what they're doing. I'm going to look at this. So I started looking at it, was able to paper a transaction, took a minute to do. Luckily,
what does papering mean?
Papering is like, okay, so when you buy a stock, it's like all figured out for you. Like you don't have to do anything. I mean, you're just like, boop. Okay, that was easy. All right, now lunchtime, everybody. I decided to buy some stock today. No, but when you're buying a claim or you're doing something in the private markets, you have to paper the whole thing. So papering is the contracts, right, and the agreements. So for instance, at Mt. Gox, like we weren't really sure how to paper it. We had to make sure we had to have escrow. What does the contract need to say? What are the representation warranties in the contracts? How do you actually transfer the claim? I mean, it's Japan. I mean, everything's in Japanese. Luckily, everything's in half English and half Japanese, and or it's in both. It's in dual language. So I was able to get it done and work through that. And that in and of itself is super valuable for these trades, like knowing how to construct and manage that risk as part of the transactions you're doing, because maybe no one's done a deal in Latvia, maybe no one's done a deal in Poland or on this kind of transaction. Maybe there's transferability issues and you need to figure that out and how to work around it. Maybe there's U.S. law sanctions against doing it and you need to find ways that are totally legal to paper.
You don't want to commit any light treason.
Yeah, light treason. I always like that phrase. I might have committed a little light treason. Is there such a thing? So it's real. I mean, you need to spend a lot of time on that, and that's not the majority of the time, but I would say that that's where the real creativity comes in. Because, if I told you, if you work through the analysis of a workout, because that's what these really are, all these kind of things are really, a lot of them are workouts. You're like, oh my God, that's it? That's so simple. You're like, yes, of course it's simple because I've done all the work for you. And you got to be able to paper it and and manage the risk of transferring with it and transacting in it. And also you have to be able to source it. The whole sourcing is a real thing. Again, you can't call up Fidelity and be like, buy me some I don't know, whatever you own. I don't
Give me
know.
some distressed debt.
Yeah. So you have to be able to source it, and the sourcing is a big part of it. So sourcing and papering are harder than the actual analysis, I think.
So I've noticed on
The
your
analysis is
website,
very
the
straightforward.
507 website has a way that you can submit your claims. You can
Oh
submit
yeah.
some distress. Do you get any leads that way?
Nah.
So
I
how do you
mean,
source it?
yeah. How do you source it? Um, Cox, I actually think I really believe that there are opportunities everywhere, and you have to constantly keep on one level, you need to be focused because you're trying to like work on your ideas and do deep, meaningful work on whatever you're researching. But on another, you kind of need to have open, right? To your antennas up always to like you're walking by a construction site and you're like, huh, these guys haven't been here for 2 weeks. I wonder why construction has stopped. Google the address. Oh, there's a work shut down because it was like, I don't know, some issue, they've run out of money. Oh, they run out of money. Oh, do they file for bankruptcy? Oh, who are the lenders? Who are the actual investors? And, maybe there's an opportunity here. Once in New York, I was walking by basically a parking lot that they had turned into like a shop, like an outdoor shopping mall, but it was all kind of like very slapdash. And they got shut down by the city because they weren't following all these ordinances. You can't just like start setting up shops. Like you have to have like all these codes in place. And so all these renters now had potential claims against the landlord. I'm like, ooh, New York City real estate claims against New York City real estate. I like that idea. So I tried to get in touch with some of the shop owners. I mean, it was very small stuff. You're talking about people that were owed like $10,000 and stuff like that. But that's an opportunity. And so I really think that you can read the paper. You can connect them with professionals in the space, of course, is great. So if you think of just like in the same way that you find stock ideas, you'd want to connect them with emerging managers and people who are doing good work. And you're just like, hey, what are you working on? What are you working on? You full on anything? Tell me about your good stuff. So that's great. The same way with us. It's like, hey, what are you working on? What's too small? What's too weird? What can't you do? Like, we look at it. So network is super important. Of course, literally just reading the paper and trying to follow distress opportunities that way. Those are really the two primary things. You very rarely get inbound stuff, although you do. Once you start getting your name out there, you do get inbounds, and that's reputation and really network. But you don't like have Facebook ads or Google ads for inbound transactions.
There was a company in Australia that, or it was just a website. I forget the name of it, but the idea of it was if you got close to tax time and you had these companies that had been delisted, I think it was called delisted.com.au. It might still be there.
Oh, I love this idea.
Delisted. So no, it was even less than that.
That's a great idea.
They said you pay us $250 filing fee, and that included like whatever, we're just going to pay some nominal sum for your shares, and you transfer them to us, but the advantage for you is you now have locked in your taxable loss for the end of the tax year. So now you can make a claim, because often what happens with these things is they just go into this, not interminable, but they go into these very long, like you were saying before, 2 or 3 years, and you want to be able to make your tax claim as soon as you possibly can, the time value of money, so on. And I often thought that is a great way to collect a whole lot of this equity, and I'll bet that 95% of it is totally worthless, and I'll bet that 5% of it actually pays off.
Yep. So we need to buy that business. So we have an idea right there. There's an idea. Let's call those guys and see if they want to sell, and or replicate. If they don't want to sell, that's easy. We'll just replicate their business.
Well, you can you don't need to replicate it in the .com.au. You replicate it in the .com.
So with interactive brokers, who I love dearly. So I won't say anything bad about it. I'm not.
So do I.
I'm from the South. We only say things nice about people. When you have stocks like that, you can sell them to them for $1, which I always think is fun. And I'm always like, oh, I wish we had a side of that trade. Because in general, there's some guys in the bankruptcy space who have done something similar like that with corporate assets, where like they'll basically buy a whole corporate, like called remnant assets, for like nothing, like $5,000. And I mean, these, nothing in the sense of like if you bought a whole portfolio and you had millions of dollars of these, and I mean, they've crushed it. It was such a great idea. And it's that same idea of like buying really, really, really cheap optionality. And again, more than 80, I don't know what the percentages are, but a lot of it is trash. But, for them, there's a lot of like what's called a sheeted property, which is basically unclaimed utility bill, metered returns and refunds and things that come to corporations that have tons of locations. Then they got Visa, MasterCard litigation in those remnant assets, which is great. And so I'm thinking
So what's your overriding sort of philosophy? I think that there are two principles. One is that you're prepared to look anywhere. You've got to be very open to where you could find any of these possibilities. The other one is, there's three. The position is very important. You want to be in the right place to make sure you've got some leverage, or you've got the payoff, you've got some return possibility. And the third is just to be alive or aware of the possibilities for that optionality where you could have a very large payout, and then to
buy the steak, get the sizzle for free. That's it. That's all investing is. Buy a steak, get some sizzle for free. I mean, I think that there's a lot of steak out there where it's like, it's just steak. I mean, there ain't no sizzle coming. I mean, this is kind of a beaten up company, and the returns on invested capital are super low. And it's like, you can make money doing it, especially as a portfolio and whatnot. But the really interesting ones are where you can kind of get some sizzle along with the steak. And the steak is basically, the steak is the price, right? So it's all price driven. You sort of like, but if you have, again, like, crypto distress is interesting because you're getting distressed pricing and you're getting a real stake because you've got a state value above what you're paying. So again, it's very price dependent. And then you get this big sizzle for free. And you could say the same thing in a lot of, you buy a liquidation, you get some lawsuits for free. That's great. Again, steak and sizzle. So I guess the more technical way to say it is you're looking for cheap optionality or free optionality or free options and things like that to talk about. I think it's better to not dress it up too much because I guess I'm a quite irreverent person. I like to joke around, but I think that I mean, keep your eyes open for opportunity everywhere. And I do think though that cheap optionality is probably the overarching theme if it was really gonna. Cheap or free optionality, because you don't know outcomes. The outcomes you don't know. I mean, I don't know. It's just, I'm very skeptical of people that have top down or thematic sort of views on stuff.
How many positions do you have in the portfolio at any one time? How much stuff are you tracking?
So I used to run an investment firm, which is BE Capital, or a fund. And now with 507, we're really just running family office money. We have two really good clients, and that's it. So we don't have a fund. So if there's nothing to do today, there's nothing to do, which I have to say I love. I love not having to do anything. Not doing anything like I don't want to work, but not doing anything like if there's just nothing that interesting. It's like you talk to your client, they're like, Tom, I don't know. I don't think this is that interesting. You're like, yeah, you're probably right. And you move on. As opposed to with a fund, it's like, oh, well, I've got all this money. I got to put it to work. I got to keep finding ideas. I got to stay on the treadmill. So I think I always think, it's interesting you talk about, and I think some of your podcast guests were talking about some of this, which is like, doing something different than the herd and all this stuff. And definitely think that's true, right? Contrarian is so important. But sometimes it's like we put ourselves in a box as investors, because we sort of get trapped by that same gotta perform every year, gotta perform every quarter, gotta be diversified by a certain amount, so it's like all these boxes that you're checking, and that's okay, you can still outperform, but it's not gonna there's a give and a get there. So
well, I think that's I like that sentiment. I think it's well expressed. But I think we're coming up on time. So if folks want to get in contact with you, what's the best way to do that?
I mean, you can email me. I think my email's on my website, but it's just tom@507capital.com. And we love inbound. So if someone's got something really weird that they can't figure out or they think is interesting, fill up on it and call us.
And we'll put links to all of that in the show notes.
Sure.
Thomas Braziel, thank you very much for spending some time with us.
Thanks, Toby. Cue the music. I love your music, by the way.
Thank you.